Let me ask you something. If the market dropped 30% tomorrow, and I mean a real drop, the kind where you check your phone and feel it in your chest, how many of your accounts would go up? Most people I talk to pause at that question because they know the answer. They have a 401k, maybe some international exposure, maybe a bond allocation. Their advisor told them they were diversified. And then March 2020 happened, and everything fell at the same time. In this video, I'm going to show you why that happened, what diversification actually means, and what it looks like when your assets are truly not correlated. If you have been watching this series, you have seen 3 problems inside the standard retirement plan. Today is video 5, and this one is about the 4th wall, the one your financial advisor calls diversification. Here is what diversification is supposed to do. When one asset class fails, the other is supposed to hold or even rise. That is the entire premise. The financial industry calls this a low correlation strategy. Correlation is just a word for how much 2 assets move together. A correlation of 1 means they move in perfect lockstep. A correlation of 0 means they have no relationship. A correlation of -1 means when one goes up, the other goes down. True diversification requires low or negative correlation, not just different looking assets. Here is the problem. In a normal market, stocks and bonds behave differently. International stocks seem to balance domestic stocks. REITs appear to move on their own cycle. And then a crisis hits, and the correlations collapse. Everything that looks different start moving together. Because when investors panic, they sell everything, and everything falls. This is not a theory. Let me show it to you on screen. Let me show you March 2020. This is a chart of 5 major asset classes during the February-March 2020 market crash. The same crash your advisor told you your diversification would protect you from. The S&P 500 down 34%. International stocks down 33%. REITs down 42%. Corporate bonds down 20%. Look at this chart. Every bar is pointing in the same direction, down. Gold held briefly. Long-term treasuries held. But most of what Marcus owns is in that left cluster, and that cluster moved as one. This is what correlation looks like in a crisis. The assets that appear different reveal that they were the same. Not diversified, correlated. Now, here is the question that matters. Is there an asset class that is structurally, mechanically, by design, not correlated to the stock market? Yes. You have already seen it. Most people have all of their wealth in bucket 1. Bucket 1, traditional assets. Your 401k, your IRA, your brokerage account. All of it tied to the same market. All of it correlated. All of it locked behind the walls we name in videos 2, 3, and 4. Bucket 2, non-correlated assets. This is where the properly structured policy lives. The cash value inside a properly structured policy does not go up and down with the S&P 500. It does not have a sequence of returns problem. It does not trigger a tax event when you access it. When the market dropped 34% in March 2020, the cash value inside a property structure policy continued to grow. This is not a sales claim. That is the contractual mechanics of the product. Bucket 3, optional growth assets. Real estate, a business, alternative investments. These are the moves you make with capital from Bucket 2 without interrupting Bucket 2 compounding. This is the structure we built for you. I know the objection. Pedro, my advisor has me in a 60-40 portfolio, 60% stocks, 40% bonds. Bonds are my hedge. And in a normal market correction, that is often accurate. Bonds have historically moved inversely to stocks. In moderate downturns, but in liquidity crisis, they do not. In March 2020, investment-grade corporate bonds fell 20%. In 2022, when the Fed raised rates aggressively, bonds and stocks fell together simultaneously for the first time in decades. The 60-40 portfolio lost 16% that year. The hedge did not hold. A properly structured policy is not a bond. It is not priced on an exchange. It is not subject to interest rate risk the same way. It does not correlate to the market because it is not in the market.
Before Pedro shows you what this looks like for your specific situation, I want to tell you about a client we worked with here in Miami. She was in her early 50s, an executive. She had done everything her advisor recommended: the 401k, the IRA, a diversified brokerage account with international exposure. She felt prepared, and then March 2020 happened. She called us about 2 weeks into the crash. She wasn't panicking about the losses themselves. She had seen downturns before. What shook her was something different. She told me, "Isis, I thought I was diversified, and everything fell at exactly the same time. I have nothing that went up." This sentence stayed with me because that is exactly what correlation feels like when you're living inside it. What she did next is what Pedro's going to tell you all about.
She implemented a properly structured policy 18 months after that conversation. By the time the next market correction came in 2022, she had a bucket 2. Her policy cash value did not fall. While her 401k dropped with the market, her policy continued to compound, and she used a policy loan to buy a discounted real estate position that her 401k could not reach without a penalty, a bank, or a tax bill. She was not diversified before. She is now. If this video added one more name problem to your list, that's exactly the right response. We have put together a free guide. Policy loans, the one financial move that lets your money work in 2 places at once. It walks through the mechanics we have covered across this series, including what non-correlated actually looks like with real numbers. Link is in the description. Download it before you do anything else. And if you are between 30 and 55, with a gross family income of $150,000 or more, and you want to see what a properly structured bucket 2 looks like for your specific income, age, and goals, book a complimentary strategy. Link is in the description. We answer every question within 24 hours. Our services cost you nothing. Now you have seen 4 problems inside the standard retirement plan. In our next video, I'm going to show you a 5th one. The assumption almost every high earner makes about their tax bracket in retirement. It is the assumption your plan is built on, and it is probably wrong. If you want to understand the full picture before you make any moves, that video is next. Subscribe so you don't miss it. We publish every week.